Good evening, everyone. Can you let me know if I'm audible? Okay. So today we are going to discuss the 2021 A-Level Part 1 paper. So I'll start off with question number 1. Which of the following statements best describes the primary purpose of accounting in a firm? So whenever they ask the purpose, the main purpose of preparing accounting, right? Accounting, just not financial, not management, just accounting. The main purpose is to provide information to stakeholders to make decisions. So those things should be there. Then the first one, reporting the transactions occurred during a particular period. That's not the main purpose. So we are reporting. Why are we reporting? To give information to stakeholders to make economic decisions. Second one, record the transaction to prepare the financial statement. It doesn't answer the question. Why are we preparing financial statement? For stakeholders to make economic decisions. Third one, communicating information for the use of manager. That is mainly for management accounting. Preparing the general purpose financial statement for the providers of capital. That's mainly talking about financial accounting. So here they are just asking what is the primary purpose of accounting in a firm. Here the most appropriate answer is the fifth one. The fifth one is saying providing the financial and non-financial information. So both financial and non-financial information. So all the information for the decision making of stakeholders. So if it is financial accounting, we provide only financial information. If it is management accounting, we provide both financial and non-financial. So this covers the overall picture about the main purpose, the primary purpose of accounting in a firm. Fifth one. Second one, which of the following accounting concepts provides the basis for classification of the portion of the long-term loan payable within 12 months from the date of the statement of financial position as a current liability? Now the bank loan, the installment, the loan amount which will pay in the upcoming 12 months, okay, upcoming year, we have to show as current liability and the remaining as non-current liability. Just like leasing, the next loan lease amount, the lease credit amount for next year, we put as current liability and the remaining we put as non-current liability. So dividing these liabilities and assets as current and non-current is based on going concern concept. Okay. And the third one, the estimated useful life of a machine owned by a firm is revised from 10 years to 8 years. The useful life of the machine, they have changed it from 10 years to 8 years, and the depreciation calculated on this revision has been recognized in the financial statement of the current year. Where do we recognize the depreciation expense? Where do we recognize the depreciation expense? Under the statement of profit or loss, right? Okay. Which of the following accounting concept provide the basis for this recognition? So we are recognizing this change in depreciation expense as an expense in the profit or loss statement, and whatever the expenses are recorded based on the matching concept. So the answer is the second one. So 5, 3, 2. Then moving on to the fourth one. Which of the following accounting equation reflect the net effect of this transaction? Okay, so then we'll say asset equals to liability plus equity. Mangala PLC purchased the office equipment for 500,000 on credit. So asset plus 500, liability plus 500. The company paid 20,000 in cash for the installation of the equipment. Again, that 20,000 we have to add it to our PPE cost. Installation cost is added to the price of the cost of the PPE equipment plus 20, cash minus 20. The office equipment loan is payable in 10 equal monthly installments. The first installment of on 31st March 2021, the first installment of 60,000 was paid. So cash minus 60, and this includes a 10,000 interest. So equity minus 10, then the loan amount in the installment is 50,000, liability minus 50. So the net impact of this equation is 500 plus 20 minus 20 minus 60, 440, liability plus 450, equity minus 10. So the answer is plus 440 plus 440 plus 450 minus 10, answer number 4. Answer number 4. Then the fifth one. What is the correct double entry to record the first loan installment paid on 31st March 2021? So the loan installment we paid is 60,000. It includes 10,000 interest, and the loan amount we are settling is actually 50,000. So then that will be office equipment loan debit 50,000, of then interest expense debit 10,000, cash credit 60,000. That's the fourth one. Then the sixth one, what is or are the source documents and primary books used to record the cost of the office equipment? Now in this question, okay, we have the office equipment purchase price is 500,000. Then we incur the installation cost of 20,000. Now both of this will be a part of the PPE cost, right? Even the purchase price as well as the installation price. Now here, the 500,000 office equipment was purchased on credit. Then can you all tell me in which prime entry book do we record that purchase? Which prime entry book do we record that purchase of office equipment 500,000? We purchased on credit. So purchase of non-current asset on credit will be recorded in the general journal. Then the next one, the company paid 20,000 in cash for the installation. So the installation price is also a part of the cost, right? Then this installation we will record in the cash payment journal. Cash payment journal. So the prime entry book to record the cost of the PPE, the 500 will go to general journal and 20 will go to the cash payment journal. General journal, cash payment journal. So already it's answer 5. Then the source document for general journal is journal voucher. The source document for cash payment journal is payment voucher. So the answer is the fifth one. Okay. Then the seventh and eighth one, we have to find the gross profit, cash account. So here, gross profit, cash balance. Okay. A firm commenced the retail business on 1st of January 2021 by investing 100,000 in cash. This firm is registered for VAT. Okay. The purchase and sales include 8% VAT. The following transactions have occurred during the month ending 31st March 2021. Now we have purchased goods for 540,000 on credit, and all these goods were sold for 648,000 on credit. Now this purchase and sales include the VAT amount, right? So we'll remove the VAT amount. Purchase VAT total. Sales VAT total. Now we calculate the VAT 8% on the purchase and sale. Then the sale and purchase is 100%. 100%. Then the total amount will be 108%. Okay. Now they're saying, right, the purchase and sales values include the VAT amount. Now here we are purchasing goods for 540 on credit. So the amount including VAT is 540. And this entire amount, this entire 540 goods were sold for 648. Then the sales including VAT is 648. Now let's remove the VAT amount and find actual purchase and sale value. 648 divided by 108 into 8. The sales VAT is 48. Then the sale value is 600. Then 540 divided by 108 into 8. The VAT amount is 40. Purchase value is 500. Now here they are saying the entire amount, okay, the entire all these goods were sold for 648 on credit. Then this entire purchase amount has been sold. Then this entire purchase amount will be cost of sale. So then we can find the gross profit. Sales minus cost of sale will give you the gross profit. Now this is a VAT registered business, right? So you should take the sales excluding the VAT. So the sale value is 600. Now this entire purchase was sold, then that entire purchase will be cost of sale 500. Your gross profit will be 100. Your gross profit will be 100,000. Okay. Then the cash balance. So cash balance here, a firm commenced a retail business on 1st of January by investing 100,000 in cash. So then opening cash balance will be 100. Okay. Then received 500,000 from debtor. Cash received 500. Yes, Hafsa, 2019 recording is there in YouTube. 2016 to 2020 part 1 recordings are available. Okay. Then cash paid. Settle creditor 360 subject to a discount of 20. Then how much have we paid to the creditor? How much have we paid to the creditor? We have settled 360, right? Fatima, give me a minute. I'll tell that. We have settled 360 and we have got a discount of 20. That means we have actually paid only 340. Cash paid 340. Then what will be the closing cash balance? 600 minus 340. That will be 260. Then gross profit 100. Closing cash balance 260. Answer number 3. So Fatima, how did I take the entire purchase as cost of sale? Because here they are saying, right, all these goods that we purchased, all these goods were sold for 648. Then the entire purchase value was sold, right? Then that will become the cost of sale. Got it? There is no any closing stock there. Okay. Then total liability and equity. Liability and equity. So for liability, here we have purchase goods for 540 on credit. So the creditors will increase by 540. Creditors wait. I'll summarize it and tell. Give me a minute. Okay. So to find the liability here, see, we are purchasing goods for 540 on credit. Okay. And here we are settling the creditor 360. Then how much will be the creditor's closing balance? How much will be the creditor's closing balance? We are purchasing goods on credit, the entire amount 540, minus we are settling 360. Then the remaining creditor's value will be 180. 180. Then next, the VAT. Our sales VAT is 48. Our purchase VAT is 40. Sales VAT is an output VAT. It's a liability. Purchase VAT is the input VAT and asset. Then what will be the net VAT liability? What will be the VAT liability? The VAT liability will be 48 minus 40, that is 8,000. Then the VAT balance will be 8,000. Is there any other liabilities? No. So then, okay, the liabilities as at the closing date will be 188. 188. Then equity. For equity, here we have a firm commenced the retail business on 1st of January 2021 by investing 100,000 in cash. Then that will be the opening capital. Opening capital 100,000. Then sales minus cost of sales, we found the gross profit as 100. The gross profit will increase equity, gross profit. Is there any other income or other expenses? There's other income, right? Discount received 20,000. There is no any other expense. Discount received 20,000. Then the closing equity will be 220,000. Closing liability 188. Closing equity 220. That will be answer number 3. 7th one answer number 3. 8th one also answer number 3. Okay. Then 9th one. Mihinadi Traders is a sole proprietorship. The employer and employee contribution of this firm to the employee provident fund is 15% and 10% respectively. Employer 15%, employee 10%. The net salary paid by the business for the year ending 31st March 2021 was 1,800,000. Now, how do we find the net salary? That is gross salary minus EPF employee contribution, you will get the net salary. Now, the EPF employee contribution is 10%. We are calculating that from the gross salary. Then gross salary will be 100%. Then how much will be the net salary if you deduct EPF 10%? That will be 90%. Okay. And then your net salary is given as 1,800,000. Then our EPF employee contribution will be 200. 1,800,000 divided by 19 to 10. That means our gross salary is 2,000. Our gross salary is 2,000. So this is our salary expense. What do we consider as our salary expense? This gross salary of 2,000. Then what will be the EPF expense? EPF expense is the employer contribution of 15%. How much is that? That is 15% of 2,300. The employer contribution is only EPF expense. So then salary expense is the gross salary of 2,000. EPF expense is the employer contribution of 15%. That is 300. Answer number 3. Answer number 3. Okay. Then the 10th one. Earlier enterprises, a sole proprietorship, reported a gross profit and a net profit of 765,000 and 540,000 respectively. Net profit, gross profit. So the net profit given is 765. Gross profit is given as 540. Okay. Answer for the 9th one is the 3rd one. How did I find the salary expense? They have given the net salary, right? Net salary is 1,800. For that, if you understood how to get this EPF employee contribution. Now, how do we find net salary? From the gross salary, when we deduct employee contribution to EPF, only you get the net salary. So, if employee EPF is 10%, okay, we are calculating that from gross salary. That means gross salary will be 100%. Then net salary will be 90%. Now, net salary is given as 1,800. For that, if you add the employee contribution, you find it as 200. You will get the gross salary as 2,000. Okay, the gross salary only we consider as a salary expense. All right. See, that's what we consider our salary expense is the gross salary amount. Okay, this gross salary amount is 2 million. Out of that, the employee's EPF contribution we have to pay. That is not an expense from us. That is the employee itself is contributing from his gross salary. From his salary amount, he is telling pay this 200 to the EPF department. Okay, so the company on behalf of the employee will pay this 200 to the EPF department, and the remaining 1,800 they'll pay in cash to the employee. So the entire salary expense is 2,000. This EPF employer contribution is an additional contribution from the company itself. The company is providing that. So that's what we consider this as an EPF expense. Okay. No. I told him this 200 is the employee's contribution. Employee is giving from his own salary. It's already included in the salary expense. Okay. These two together will give you EPF payable. EPF payable 500 if you have not paid yet. Is that clear, Mariam? Part 1 series, Hamna, no. The P1 500, the books are over. All 120 slots are filled. So I don't have any books to give for. If in a question they say PLC. Yes, Abdullah. Yeah. If the question says it's a public limited company, you should assume that it's a VAT registered business. Yeah, part 2 you can join. Part 2. Okay. Then 10th one, net profit 765. Sorry, I have mixed it up. Gross profit and net profit. Yeah, Mariam here. This is the working for the 7 and 8. Okay. This is the working for the 9. Okay. Now here they have given the gross profit as 765 and the net profit as 540. The stock loss during the year was 65,000. Okay, they have maybe the stocks are damaged or something, 65,000. Okay, the closing inventory had been ascertained based on physical stock. They have gone to the warehouse and counted and seen, okay, this much only closing stock we have. However, no adjustment has been made in the books of account. Now, if they have not recorded the stock loss, okay, now stock loss we have to deduct under cost of sale. If they have not recorded it, our cost of sale is undercosted or overcosted. Our cost of sale is undercosted or is it overcosted? Cost of sale is overcosted, right? Because we haven't deducted this. We have to deduct our damaged stock from cost of sale. If they have not deducted, cost of sale is overcosted. That means we have to deduct, right? Now, if we deduct this 65, now if we are going to deduct this under our cost of sale, our gross profit will increase or decrease. Our gross profit will increase or decrease. Our gross profit will see. We have to deduct this under cost of sale. Okay. We have to deduct this under our cost of sale. Then our cost of sale value will decrease when we record this. Then if the cost of sale value decrease, our gross profit will increase, right? The gross profit will increase. So you have to add that 65. So now Fatima here, this stock loss, they are referring to the damaged stock. Yeah, they are referring to the damaged stock here. Right. Give me a minute. Yeah. Cost of sale and gross profit has a negative relationship. Yeah, give me a second. Okay. So here, right, we had a gross profit of 765,000 and a net profit of 540. Now the stock loss of the stock damage, they have not recorded the 65,000. Now we have to deduct the stock loss under cost of sale, right? Now if we deduct it under our cost of sale, our cost of sale value will decrease. Okay. Then our gross profit, what will happen? If we are decreasing our cost of sale, gross profit will, what will happen, Fatima? Uh, Gross profit will increase because now cost of sale is deducted from sales to get gross profit. So if the cost of sale, which is an expense, decrease, our gross profit will increase. So we are adding that stock damage to the gross profit 65. Okay. Yeah, negative relationship. Okay, cost of sale and gross profit has a negative relationship. Okay. Then anything, if the gross profit is increasing, automatically what will happen to net profit? If the gross profit is increasing, automatically because of that reason, net profit also will increase by 65. Okay, still we are not done, 65. And then, now where should we record this? Where should we record the stock loss? Where should we record the stock loss? Under other expense. Then now what will happen to net profit? Now what will happen to net profit because we are recording it under other expense? Now net profit will decrease. See, expenses will decrease your net profit. Now you're recording under other expense, then your net profit will decrease. Then our gross profit will be the corrected gross profit 830. Net profit will still be 540. So you can see due to this transaction, there is no impact to our net profit. Why? Because we are deducting from the cost of sale, then that will increase gross profit, and we are again recording it under other expense. We are still Hamna, you mean you didn't get it? Why do we deduct it here? Is that the problem? Why do we deduct instead of adding? That's your doubt. Okay. So now this 65 we are recording as other expense, right? We are recording as other expense. So then, okay, our other expenses are increasing. Is it clear? Other expenses are increasing. So if the expense is increasing, what will happen to profit? The profit and any expense has a negative relationship. Okay. So that's the reason we are reducing it under net profit. Okay. So then the answer is 830, 540, answer number 4. Okay. Damage stock try to include under cost of sale. So here, now stock loss normally we take as what? The damage stock minus the selling price of it normally, right? And we get the net amount, or maybe how much we can recover from insurance if we deduct, we get that net amount as the loss. Okay. Now here, have they mentioned anything like that? No. So we can consider that this entire stock loss amount was the damage stock amount. Okay. So if there is a stock loss, that means there was a damage stock as well, right? Alright. Then the 11th one. Following information has been extracted from accounting book. Yes, Hamnaya. Firstly, we added because it affected the gross profit. Second, we deducted because it affects the other expense. Okay. Then, here we should find the prime cost and total manufacturing cost. So, prime cost, how are we going to find? Opening raw material plus purchases minus closing raw material. This will give you the consumed raw material. Consumed raw material. Now, opening raw material is 100. Purchased raw material is 130. Closing raw material is 70. Then how much is the raw material we have consumed? How much is the raw material we have consumed? 100 plus 130 minus 70, 160. 160. And for this, we have to add our direct labor. Direct labor. The direct labor cost is 70. Direct labor 70. And then is there any direct other cost? Now here you can see royalty payment on production unit. The royalty payment on production units are direct other expense. Direct other expense. How much is that? 30. Then what will be your prime cost? Your prime cost will be consumed raw material 160 plus direct labor 70 plus direct other 30. Prime cost will be 260. 260. Okay. Yeah. Raw material consumed is the direct material amount. Yeah. Okay. That you can say here direct material. All right. Then now they are telling to find the total manufacturing cost. Then now for the prime cost that we found, prime cost 260, you have to add the production overhead. Production overhead or factory overhead is 35. 35. And they have given work in progress. They are saying during the year, work in progress increased by 15. Without giving the opening and closing work in progress separately, they have given the increase in work in progress. How do you find the increase in work in progress? That is closing work in progress minus opening work in progress. Now, can you tell me the increase in work in progress, should we add it or deduct to find the manufacturing cost? The increase in work in progress, you have to deduct it. Yeah. Yes, Hamna. Now, no classes on Saturday anymore. Tuesday and Thursday. We have to deduct the increase in work in progress. You have to deduct minus increase in work in progress. That is how much? Increase in work in progress 15. You have to deduct. Then what will be your production cost or manufacturing cost? 280. So prime cost is 260, total manufacturing cost 280. Answer number 4. Answer number 4. Okay. To 2021, Sima. 2021. Okay. Then next, the 12th one. Sunimal traders sell goods, keeping a profit margin of 20% on selling price. What is the purchase? Okay. First of all, now here they have given the cost of sale related details. Then we can reverse and find how much is the purchase. Now, the sales is given as 1050. Now, the profit is calculated 20% on sale. Then what will be the profit? What will be the gross profit there? 20% of 1050 is 210. 210. Then if 20% of the sale is the profit, the remaining 80% will be cost of sale. And how much will be, this is the profit. Then how much will be the cost of sale? 1050 minus the profit 210. The cost of sale will be 840. Cost of sale will be 840. Now we can reverse and find the purchase. Opening stock plus purchase minus purchase return plus carriage inwards minus closing stock will give you your cost of sale. Cost of sale we found as 840. Opening stock 140. Purchases we don't know, we have to find. Purchase return 50 you have to deduct. Carriage inwards 40 you have to add. Closing stock 170 you have to deduct. And if you reverse and go, you can find your purchase value. 840. Now closing stock here minus, when you're reversing, you have to add it. 840 plus 170 minus 40 plus 50 minus 140. Your purchase value will be 880. 880. 880. Answer number 2. Answer number 2. Okay. So then next one, 13th one. The following information has been provided for Sarana Welfare Association for the year ending 31st December 2020. So now here you have to prepare a subscription account. You have to find a subscription income, then you have to prepare a subscription account. Subscription. Subscription receivable as at 1st of January 2020. Opening receivable is an asset. It will come in debit side 192. Subscription received in advance opening. It's a liability. In the credit side BBS 60. Okay. Now subscription received during the current year. During this year, you received 144 for last year, 1,092,000 for this year, and 108 for the next year. Then totally how much of subscription have you received during this year in cash? 144 plus 1,092 plus 108, that is 1,000,000. 344. Okay. Now what will be the double entry for that? Cash debit, subscription account credit. So cash 1344. Now here we have received during this year we have received 108 for next year as well. Okay. So that will become the closing advance, right? Opening advance is credit, then closing advance BCD will be 108. And next, subscription receivable as at 31st December 2020 is 96. Closing receivable 96. Then you can balance off and find the income for the year. 60 plus 1344 plus 96 will give you 1500. 1500 minus 108 minus 192, the income and expenditure amount to be recorded as income in the income and expenditure amount, that is 1200. That's the for the year amount. Okay. So then 13th one done. 14th one. Which of the following statements are correct as to the section 24? They are asking for section 24 of the Partnership Ordinance of 1890. Okay. Partners are entitled to an annual interest of 5% on the loans provided by them to the partnership. Correct. Okay. In the section 24, they are saying if the partner, existing partner, provides the loan to the partnership addition to the capital, you have to give a 5% interest on that. B part. Partners are entitled to an annual interest of 5% when the amount payable on retirement is outstanding. So when a partner retires and the amount payable to him, we should pay 5% interest. Is it based on section 24? No. That is based on section what? That is based on section 42. Section 42. Okay. Hamna, I think in the 2016 or 17 paper, I explained the theory part. It's there in the recording, you can check. If not, just message me. I'll send the first page of my tute in that, my fast track tute, I have given that as a shortcut. Okay. This is based on section 42. Then C part. Partners are entitled to salary when they contribute for management. Section 24 is saying don't give salary for partners. That is wrong. D. Partners are entitled for reimbursement when they pay an expense of the partnership from their personal fund. When the partner pays the expense of the business from his personal money, he has the right to get that money back reimbursed. That's based on section 24 itself. It's mentioned in section 24. Then A and D, they are asking for the correct statement, right? A and D, answer number 2. Okay. Then 15th one. Mariam, you mean 2021 part 2? 2021 part 2 I'll discuss on Thursday. Okay. Alright. So then 15 and 16. What is the estimated goodwill of the partnership? Okay. So now here, Amal and Saman carried out a partnership. Alright. Amal and Saman. After that, what is happening? On 31st March 2020, Malik was admitted. Okay. Now what we have to find? The goodwill. So we can balance off and find it. Amal, Saman, Malik. Amal, Saman, Malik. Now I'm preparing the partner's capital account. Okay. BBS. Opening balance of Amal and Saman is 300 and 200. Now Malik is joining and paying. Malik is contributing 500,000 as capital. Okay. And they have given the closing balances of capital BCD 330, 220, 450. Okay. Then the goodwill you can find out new ratio debit, old ratio credit. Now new ratio is 3:2:1 between Amal, Saman and Malik. Old ratio is between Amal and Saman only. So Malik doesn't have a old goodwill ratio. Okay. Now when you balance off this, Malik column 500, 500. If you deduct the BCD, the Malik goodwill portion is 50. Now this debit side is based on the new ratio, right? New ratio is 3:2:1. Then Malik's portion is 1, that is 50. Then Saman's portion will be 100. Amal's portion will be 150. Then what is the total goodwill amount? 150 plus 100 plus 50, that is 300. The total goodwill is 300. So answer number 3. How you can do it? You see here, Malik is contributing 500,000. His closing capital balance is 450. That means his capital amount has decreased by 50,000. That is his goodwill ratio. The goodwill ratio is 3:2:1. Then if Malik's capital is reducing by 50, his goodwill portion is 50. Then Saman will be 100. Amal will be 150. The total goodwill you can find as 300. That way, it's the shortcut, you can find it easily. Okay. Next one. What is the equity of the business and Amal's current account? So first of all, current account. Okay. Now here, Malik is joining at the end. On 31st March 2021, Malik was admitted. Then current account should be prepared only for Amal and Saman or for all Amal, Saman and Malik. Malik is joining at the end of the year, and we won't give him any profit to whatnot, right? Then we can prepare the current account only for Amal and only for the two partners, Amal and Saman. Okay. Then yeah, only for Amal and Saman. So Amal and Saman. Amal's and Saman opening balances are 60 and 50. 60, 50. Now here, the partners are not paid any salary or interest on capital. No salary or interest on capital for the partners. The net profit of the partnership for the year ending 31st March 2021 was 150,000. So if no profit, no salaries for partners or interest on capital, you can directly divide the profit between Amal and Saman based on their profit sharing ratio 3:2, right? So Malik is joining at the end. So throughout the year, you should follow the old agreement. So the profit sharing ratio between Amal and Saman 3:2. Then if you divide the profit of 150 between Amal and Saman, how much will that be? 150 divided by 5 into 3, 90 and 60, right? 3:2. Then this is the opening balances. Then the closing balances will be 150 and 110. Okay. Hamna, which part didn't you get? Oh, okay. See here, the net profit of the partnership is 150, right? Net profit 150. Okay. How will you divide the profit between the partners? How will you divide the profit between the partners? Based on the profit sharing ratio. What is the profit sharing ratio between Amal and Saman? 3:2. Then here profit is 150. Out of this 3, you should give to Amal, 2 you have to give to Saman. So then Total ratio is 5, right? Then 150 divided by 5 multiplied by 3. For Amal, it will be 90. 150 divided by 5 into 2. For Saman, it is 6. Got it? Okay. Alright. So here, they are asking the 16th one, the total equity of the partnership and Amal's current account. Now, how do you find the equity balance? Equity equals to capital account plus the current account. Current account. Capital account. What is the total of the capital account? 330 plus 220 plus 450. Total capital account, the closing balances are 1,000,000. Then the current account, Amal and Saman, 150 plus 110, that is 260. Then the total equity will be 1,260. Total equity 1,260. The Amal's current account balance 150. That is answer number 5. Okay, answer number 5. Then 17th one. Which of the following factors affect the change in inventory cost per unit calculated as per weighted average cost method? Now, how do we find the weighted average cost price? How do we find the WAC price? WAC price equals value of inventory as at the issue date divided by number of units. Okay. Now, purchase price. Will the purchase price affect the value of inventory? Yes. The value of inventory will increase. Therefore, what will happen? The WAC price will increase. No, wait. It depends on the value. So, all right. So then, now this purchase price will affect your value of inventory and number of units. The proportionate, now normally when you buy inventory, the prices keep on increasing right time to time because of inflation. So when you purchase, all right, the value of inventory will increase proportionally higher than the value of the increase in number of units. Therefore, the WAC price will increase because of this. WAC price will increase. Then quantity purchased. If we I'll just tell what will affect. Okay, your purchase price, the quantity purchase, opening stock value. Okay, this will affect the what WAC price. The average price will be affected because of this. Because how do we find the average price? The total inventory value divided by number of units. So all of this affect either the number of units or especially the value of the inventory. Purchase price, the quantity purchased and opening stock. If I'm to explain this through an example, it might take a lot of time. Okay, so purchase price, quantity purchase, cost of opening stock will affect the WAC price A, B, and D. Okay, the issuing, okay, the quantity issued, how much you sell will not affect. Okay, how much you sell, because you're already selling at the average price, right? Because of that, the quantity issued will not affect the average price of the inventory. So anything other than the quantity issued, anything other than issues, okay, will affect your inventory. The quantity purchase, the purchase price, opening stock, right? The value of the opening stock, okay, those will affect your average WAC price. So the answer is A, B, and D. A, B, and D, answer number 4. Okay. Then 18th one. Madhushika PLC was incorporated on 1st of April 2016. The company revalued its land for the first time on 31st March 2019 and it resulted on a surplus of 500. In 2019, they revalued the land and got a surplus of 500,000. Okay. Land were revalued again on this year's end. They revalued it for, okay, land revalued again. It resulted in a deficit of 300. Okay. Further, the company revalued its office equipment on 31st March 2021 for the first time and it resulted in a deficit of 800. Now the first time deficit will go to where? The first time deficit will be recorded under this 800 office equipment deficit 800 will go to other expense. The first time deficit will go to other expense. Okay. Now the land deficit. Land we got a deficit of 300. Where will that be recorded? See, last time in 2019, we got a surplus of 500,000. We got a surplus of 500,000. This year, we got a deficit of 300. That last time surplus, where did we record in 2019? In 2019, we recorded in the other comprehensive income. So what we can do, this deficit of this year, we can set it off under other comprehensive income. So that 300 second time revaluation deficit will be set off under other comprehensive income. Okay. All right. Then what we should do, we have to record 800 under other expense and record 300 under other comprehensive income. So recognize 800,000 in profit or loss. Profit or loss. Other expenses in profit or loss statement, right? And the 300 under other comprehensive income. Answer number 5. This year 200 means no. There will be a remaining. There will be a balance 200 under revaluation reserve. Okay. Now opening revaluation reserve will be 500. Now this year under other comprehensive income, you are deducting 300. When you take it to the statement of changes in equity, you will have a closing balance of revaluation reserve 200. Okay. 91. In which of the following situation a provision is recognized in the statement of financial position? Okay. Sale of goods with a 1-year warranty. Sale of goods with a 1-year warranty, do we make a provision? Yes. Based on LK 7. Okay. Depreciation of property, plant and equipment. Is it based on LK 7? Now we have two type of provision. Provisions, I'll explain that. We have asset provisions and liability provision. Can you tell me some asset provisions? Asset provision. Provision for depreciation. That means accumulated depreciation. Provision for depreciation. Then provision for doubtful debt. Allowance for expected loss. Provision for doubtful debt. These are asset provision. Liability we have provision for warranty, provision for warranty, provision for compensation, right? So many provision, whatever the liability provision, okay? So yeah, provision for claim. Yeah. Profit or loss means here we are recognizing in other expense. Okay, no. Accrued expense is not a provision. Provision is when you're uncertain about the timing and amount, right? Okay, like this, you have provision for liabilities. Remember, in LKAS 37, you're only giving provision for liability. LKS 37 doesn't accept provision for asset. Okay, that theory doesn't come under LKS 37. So, sale of goods with 1 year warranty, that's provision for warranty, you will make a provision based on LKS 37. Depreciation is an asset provision. Undertaking to repair and defective goods sold as per the past practice. That means you have a practice of repairing defective goods and giving to your customer. For that, you will have to make a provision. This is what you call it constructive obligation. Constructive obligation. Because now, according to the law, you don't have to repair the defective goods. But because of your past practice, you are keeping on doing it. That's a constructive obligation. For constructive obligations, you can make a provision based on LKS 37. So you can make a provision for A and C, answer number 4. 20th one. Which of the following situations can be considered as a change in accounting policy as per LKS 8? Okay. Change in depreciation method from straight line method to reducing balance. Is it a change in accounting policy? Is it a change in accounting policy? No, this is an accounting estimate. Remember, a change in the depreciation method is not a policy, that is a estimate. Okay, you have depreciation policy, that's a different thing. Okay, second one, change in the cost formula used in inventory valuation from weighted average cost to FIFO method. That is a policy. That is a policy. See, change in the measurement base from the cost model to revaluation model, that is also a policy. So policies you have B and C, answer number 4. Answer number 4. Okay. Then 21. Roshan PLC entered into a lease agreement on 1st of April 2020 to obtain the right of use of a motor vehicle for a period of 4 years. On this date, a down payment of 1,500 was paid. You paid a down payment of 1,500,000. The initial measurement of lease liability was 3,500. Lease liability 3,500. Then can you all tell me what is the cost of the lease asset? How much is the cost of the asset? For the down payment, if you add the lease liability, you will get the cost of the asset. How much is that? That is 5,000. Now what are they asking? What is the depreciation of this motor vehicle? Now here they are saying, as per the lease agreement, the lease ownership of this asset is transferred to Roshan PLC at the end of the lease term. The useful life of the motor vehicle is 5 years. And can you all tell me, because that ownership is transferred to Roshan PLC, are we depreciating based on the lease period or are we depreciating based on the useful life? Are we depreciating based on lease period or useful life? Because the ownership is transferred, we have to depreciate based on useful life. Depreciation equals to cost divided by useful life. If there is any residual value, you have to deduct residual value. Okay. So cost is 5,000. There is no residual value. Divide by useful life 5 years. The depreciation for the year is 1,000. Depreciation for the year 1,000. Fourth one. Hamna to see what? How to figure out whether we use the useful life or lease period. So here see, here they are saying, as per the lease agreement, legal ownership of the asset is transferred to us. Okay, Roshan PLC, our company. The ownership is transferred. Okay, now here see, lease period Here we are obtaining a right of use asset for a period of 4 years. That is the lease period. For how long we have to pay the installment. Here they are saying the useful life is 5 years. Now, if the ownership is transferred to us, we have to divide it based on useful life to figure out the depreciation. If it is not transferred, we have to see lower of cost and lower of useful life and lease period to calculate depreciation. Okay, so that is 1000 answer number 4. Give me a minute. Then 22 and 23. Profit, total comprehensive income, retained earnings, and equity. Okay. The stated ordinary share capital, and retained earnings of Saman PLC as at the opening date were 8,000 and 2,000 respectively. Total income and total expense recognized for the year ending 31st March 2021 of the company were 3,000 and 1,800. And how do you find total comprehensive income? Total comprehensive income equals total income minus total expense. Total income is 3,000, total expense 1,800. Then how much will be the total comprehensive income? Total comprehensive income will be 1,200. Okay. Now next they are saying the total expense recognized for the year include a deficit of 600,000 resulted from revaluation of machinery from the second time. Okay. During this year, we revalued our machine and got a revaluation deficit of 600,000. The revaluation of this machine for the first time on 31st March 2018 had resulted a surplus of 400,000. Now, our total comprehensive income can be divided as profit after tax and other comprehensive income. Last time we had a revaluation surplus of 400,000. This time we have a revaluation deficit of 600,000. Now, what on the other comprehensive income? What is the amount we can set off? We can set off the 400. Last time we got a surplus of 400 and we recorded it under OCI. This time we are getting a deficit of 600. So that last time surplus we can set off under OCI 400 and the remaining 200 we can record under other comprehensive income. Then what will be our profit after tax? If total comprehensive income is 1,200, out of that is other comprehensive income is minus 400. How much will be the profit after tax? Profit after tax is 1,000. Profit after tax will be, see, profit after tax plus OCI is only total comprehensive income. Total comprehensive income is 1,200. OCI minus 400. Then how much will be profit after tax? 1,600. 1,600. Got it? Mariam, you mean to explain this entire thing again? Then profit for the year is 1,600. Total comprehensive income 1,200. Answer number 4. Okay. How do you know 400 is OCI? Now see here, last time in 2018, we got a surplus of 400,000. Okay, for the first time we revalued and got a surplus of 400. Where will we have recorded it in 2018? Where have we recorded it then? That first time surplus, where will you record? Under OCI. That's in 2018. Now in 2021, this year, we are getting a deficit of 600 when revaluing our motor machinery. Okay. Now you know, right? If you, I hope you know the theory. If you have got a deficit this year and surplus last year, you can set off that deficit from the surplus. Yes, Mariam, the 200 goes under other expense. Okay. Now here, we got a deficit of 600. Last time we got a surplus of 400. Out of this 600, what is the maximum amount you can set off under OCI? What's the maximum amount you can set off? 1600. No, out of this deficit of 600, using this surplus of 400, you can set off only 400, right? This deficit of 600, you can set off 400 from the last time's surplus of 400. So under OCI, you can deduct 400, and the remaining 200 of deficit will go to other expense. Okay? Is that? Oh, okay. No, Mariam. Yeah. The 200 is there in the profit. Okay. So for us, what is easy to find first? OCI. That's why I found the OCI first and then substituted the value and got the profit after tax. Total comprehensive income only equals to the total income minus total expense. Okay. Then the total comprehensive income includes profit for the year and the OCI. 1200. That's not how you find it. I mean, you will get the answer, but that's not the logic behind that, Mariam. 1200 is not your profit. Okay, the profit. Okay, yeah. How to find it? Then next 22. So 22, the answer is the fourth one. 23. The retained earnings and equity. Okay. Here, opening retained earnings is how much? Opening retained earnings is 2 million. For the retained earnings, you have to add the profit. Profit is 1600. From that, you have to deduct the interim dividends of 500 minus dividend paid. Do we record this? The board of directors has proposed to pay final dividend of 800. Do we record that? Yeah, you can draw a ledger for this to find retained earnings. No problem. Okay. Do we record the proposed dividend? No, we don't. Then what will be the closing retained earnings? How much will be the closing retained earnings? That's gonna be 3,100. 3,100. Okay. And they are also asking for the total equity. So our stated capital is how much? Stated capital is 8,000. For that 8,000, if you add your retained earnings 3,100, you will get your total equity as 11,100. 11,100. So retained earnings 3,100, total equity 11,100, answer number 3. Okay, answer number 3. Then next one. 24 ratios: earnings per share and dividend per share. So how do you find earnings per share? Earnings per share is profit for the year, profit for the year divided by number of shares. What is the profit for the year in this question? Profit before tax is 1,080,000. The income tax is 80. Then what will be the profit for the year? Profit before tax minus income tax 80. Profit for the year is 1,000. Profit before tax is, sorry, profit after tax is 1,000. 1,000 divided by the total ordinary share capital is 10,000. 20 rupee per share. Then how much is the number of shares? How much is the number of shares? 500. Now here actually it is profit is 1 million. Here it's in thousands. The profit is 1 million. Number of shares is 500,000. Okay, 500,000. We are writing in thousands. Yeah. How did I find profit after tax? That is profit before tax minus income tax. PBT 1,080,000 minus tax 80. You will get profit after tax 1,000. Okay. How did I get 500? The total here is the total value of shares is 10 million. 10 million divided by the value of one share is 20. Then how much is the number of shares? 500,000. 500,000 shares. Okay. So here I'm writing in thousands. That's what I just wrote as 500. All right. So then EPS will be how much? Rupees 2 per share. Rupees 2 per share. Okay. All right. Then dividend per share. Dividend per share. Okay. Dividend per share will be dividend paid divided by number of shares. Dividend paid divided by number of shares. The dividend paid amount is 300. Number of share 500. So 300,000 and 500,000. Then what will be the dividend per share? That will be rupees 0.6 per share. Then EPS is 2. Dividend per share is 0.6. Answer number 3. Answer number 3. Okay. Then 25. Return on equity ratio and interest cover ratio. So return on equity ratio equals profit for the year divided by equity capital into 100. The profit for the year we found as 1 million divided by how much is the total equity? Here they have correctly given the closing equity balance. So stated capital 10,000 plus retained earnings 700. That will be 10,700 into 100. Now remember guys, sometimes they will give the opening retained earnings. If they give the opening retained earnings, you have to add the profit for the year minus the dividend paid and get the closing retained earnings. Okay. So then now return on equity will be how much? 1,000 divided by 10,700 into 100. That will be 9 point, you can round it off, 9.35%. 9.35%. Then interest cover ratio. Interest cover ratio equals profit before tax plus interest divided by interest. Profit before tax is given in the question as 1,080. Profit before tax 1080. Interest is given as interest expense is given as 160 divided by 160. So 1080 plus 160 gives you 1240 divided by 160. That will give you 7.75 times. So 9.35 and 7.75 times, answer number 3. Okay. Then 26. Which of the following statement is correct in relation to classification of cost? Okay. All direct costs are variable cost. Is that true? Now direct cost. Remember, direct cost equals to the prime cost. Okay. Are all the prime costs variable cost? Sometimes no. Now, for example, carpenter is a direct labor. Okay. So direct labor is prime cost. Now, sometimes we will pay the carpenter a monthly salary. So that is not variable, that is a fixed cost. But still, it is a direct cost, right? So always the direct costs are not variable cost. Second one, all the indirect costs are fixed cost. Indirect costs are overheads. We have variable overhead as well as fixed overhead. So second one also wrong. All the overheads are indirect cost, correct? Okay, another name for indirect cost is indirect cost overhead. Overhead. So that is correct. All the direct costs are product cost. Now I said direct cost equals to prime cost. Are all the prime costs included under production cost? Yes. So all the direct costs are included in product cost. So answer C and D. Answer number 4. Answer number 4. Okay. Then 27. How D? Okay. See, all the direct cost are product cost. Okay. Product cost equals prime cost plus production overhead cost. Okay. I said direct cost means prime cost, right? Is prime cost included in product cost? Yes. So therefore D is correct. It's a clear answer. Okay. Then 27. The reorder level and reorder quantity of a raw material used by a manufacturing business is 2000 kilogram and 5000 kilograms respectively. Okay. Minimum consumption of raw material is 200. Minimum and maximum lead time are 3 weeks and 5 weeks respectively. They're saying to find the maximum stock level. So maximum stock level equals reorder level minus minimum consumption into minimum lead time plus ROQ. Reorder level is given as 2000 units minus minimum consumption for a week is 200 units multiplied by minimum lead time is 3 weeks plus reorder quantity is 5000 kilograms. Reorder level 2000, minimum consumption into minimum lead time is 600 plus 5000. What will be your maximum stock level? 6400 kilograms. 6400 kilograms. Answer number 4. 28. The steps followed in the identification of overheads to a cost unit are given below. Okay. What is the correct sequential order of this step? Overhead costing, what is the order? First of all, you have to collect the overheads. Okay. Then whatever the overheads you can directly apportion, the overheads you can directly identify for each department, you can directly record it to that department. That is called allocation. Number 2. After that, whatever the overheads that cannot be identified directly, okay, you have to divide it based on a ratio. That is called apportionment. Finally, you have to find the overhead absorption rate. That's the fourth step. So BADC, answer number 4. Okay. Then 29. The break-even point of a company is 6,000 units. The selling price of a unit and total fixed cost are 200 and 480,000 respectively. They are telling to find the variable cost and the profit of the company when 8,000 units are sold. Now, first of all, to find the variable cost, we'll find the contribution. They have given the selling price, right? Now, BEP unit equal to total fixed cost divided by contribution per unit, right? Then you can substitute this equation saying contribution per unit equals total fixed cost divided by BEP unit. Okay, so then total fixed cost is 480,000 divided by the BEP units is 6,000. How much will be the contribution per unit? Contribution per unit will be 80. Okay, so now selling price is 200. From selling price, if you deduct the variable cost only, the variable cost is, we don't know, we have to find, you will get the contribution. Contribution we found as 80. If the selling price is 200 and the contribution is 80, what will be the variable cost? Variable cost will be 120. And they are saying to find what will be the profit at 8,000 units. So a simple equation for profit is profit equals total contribution minus total fixed cost. Total contribution at 8,000 units will be, now for 1 unit the contribution is 80, then for 8,000 units that will be 640,000. Okay, how did I find this? 80 rupees per unit into 8,000 units. Total fixed cost is given as 480,000. Then what will be the profit at 8,000 units? 640,000 minus 480,000. That will give you profit of 160,000. So then variable cost per unit is 120. The profit is 160,000. Answer number 3. Okay. Then the last MCQ. Amara PLC is considering to acquire a machine for a new project. The purchase price of this new machine is 3 million, and its expected useful life and residual value is 5 years and 500,000 respectively. They have given the profit after tax and they are telling to find the payback period. Now, payback period, are we looking it based on the cash flow or profit after tax? Tell me that. The payback period, are you looking it based on cash flow or profit after tax? Payback period is found based on the cash flows, right? Based on the cash flow. Okay. Now, how do you find the cash flow? From profit. Okay. Cash flow equals to profit plus depreciation. Now, depreciation is a non-cash expense, right? If you reverse it back to the profit, you can get your cash flow. Okay. Now, the profit for each year is given. We have to find depreciation. Depreciation equals to cost minus residual value divided by useful life. Okay. Now, the cost is 3,000. Residual value is 500. Okay. Then divide by useful life 5 years. What will be the depreciation for a year? 3,000 minus 500 divided by 5. That will be 500 for a year. Okay. Now, when you add the depreciation for the profit of each year, you will get the cash flow. Cash flow of year 1, year 2, year 3, year 4, year 5. Okay. Profit for year 1 is 250. If you add the depreciation 500, cash flow will be 750. Year 2, 750 plus 500, 1250. Year 3, 500 plus 500, 1000. Year 4 and 5 will be 1500 and 1500. Now you should find the payback period. Now how much should you, what is the amount you have to recover? Now what does payback period means? How long will it take for you to recover your initial investment? Now your initial investment is 3000. Okay. Now in year 1, you can recover 750. In year 1, you can recover 750. Now how much is remaining to recover? Another how much is remaining to recover? 3000 minus 750. You have to recover another 2250. Now in year 2, you can recover that 2250 with, now you are getting 1250 in year 2. Now how much is remaining to recover? 2250 minus 1250, 1000. Now you can recover the 1000 in year 3. 1000 minus, in year 3 you are getting a cash of 1000. Now there is no any remaining amount to recover. Totally how many years did it go for you to recover this initial investment of 3000? It took you 3 years to recover, right? It took you 3 years to recover. So answer number 2. Answer number 2. Okay. So we're done with MCQs. Okay, sure. Show the working for 22. Yeah, this is the working for 22 and 23. Mariam, and then okay, okay. Then Fatima 27, 27. This is the answer number 4. Okay. Then Mariam Azam, question number 29. Yeah, this is the working. Okay. Done. Okay. Then question number 31. True or false in relation to accounting of a firm? Every business carried out with a profit motive must prepare financial statement based on accounting standards. Profit motive business, what do you have? Sole proprietorship, partnership, PLC, public limited company, private limited company. Is it compulsory for all of this profit making business to follow accounting standards? No. For whom is it compulsory? It is must only for the companies, right? Mainly the PLCs, right? The public limited companies only. It is mandatory to prepare accounting statements based on accounting standards. For other businesses like partnership to whatnot, it is not compulsory. If they want, they can follow. If not, no one is going to say anything. So this is false. B. The general purpose financial statements are prepared primarily focusing on the information needs of the fund providers of the business. In the first class itself, we studied, right, in the 2017 paper. General purpose financial statement, we mainly prepare in order to give it to our resource providers. Therefore, that is true. C. The content of the financial reports of the business could change in response to a change in environmental factors. Yeah, because of a change in environmental factor like in economic environment, legal environment, we have technological environment, professional and technical environment. If there's a change in these environmental factors, the way we show our information also can change because of that. So this is true. D. The identification of transaction is the initial step of the accounting process of the business. Correct, right? The first step of our accounting process is to identify the transaction or the occurrence of transaction. That is also true. 32. State whether the following transaction of a coconut oil manufacturing business could lead to an increase, decrease, or no change in the equity balance shown in the accounting equation. Okay. Purchase of coconuts on credit. What's the impact on equity? Purchases on credit. Liability increase. On the other hand, stock will increase. Is there any impact on the equity? No. So you can say no change. The purchase will not have an impact on equity. B. Sale of coconut oil on credit with a profit. Sale of coconut oil on credit with a profit. So the profit amount will increase your equity. Payment of cash to a coconut supplier subject to a discount. When you pay money to the coconut supplier and get a discount, that is a discount received. It is an income, therefore your equity will increase. Final one, obtaining coconut oil by the owner for personal use, that is drawings, that will decrease your equity. Decrease. Okay. 33. State the prime entry book used to record each of the following transactions took place in Madura rice mill. Okay, it's a rice mill. Then purchase of paddy from farmers on cash, cash, payment, journal. Purchase of a rice processing machine on credit. Purchase of a non-current asset on credit will go to a general journal. Sale of rice to wholesale traders on credit. Sales journal. Sale of broken rice for animal food producers on credit. Sale of broken rice for animal food producers on credit. So that's also a sale. So you can record it in a sales journal, the credit sale. Or in the marking scheme, they have given marks for general journal as well. Why? Because now some students might think, now normally what do? We have to sell rice. Okay, that is our main activity. Now sale of broken rice on credit, that's not a main activity. Because of that, some students might record it in general journal. That's also correct. Okay, sales journal or general journal. Then 34. The debtor control account balance of a business as at 31st March 2021 was 560. The balance did not agree with the total of debtor ledger balance on this date. The following were revealed in the subsequent investigation. No. If you all are confused, don't go to write two answers. You all can write only one answer in your paper. Okay? Don't go to write two answers. 34. The total balances of debtor ledger before correcting the above errors and the revised balance of debtor control account. So you have to prepare the adjusted debtor control account and the debtors list reconciliation. Debtors list reconciliation. So firstly, you will record the adjusted debtor balance, and then you will get the debtors list balance before correcting the errors. Okay. Now here the debtor control account balance of the business as at 31st March 2021 was 560,000. So adjusted debtor balance before correcting opening balance will be 560. Before adjusting balance is 560. And this did not agree with the total of debtor ledger. Okay. Now we'll correct it. A debtor balance of 20,000 written off as bad debt in the debtor ledger. Debtors ledger means personal account. And that means they have recorded in the personal account has not been posted to debtor control account. then they have not recorded in debtor control account, so you have to record it. Then bad debt will be in the debit side or credit side in the just the debtor control account. In which side should we record that 20,000? In the credit side. So you're going to say bad debt 20. A sales invoice of 42,000 has been recorded as 24,000 in the sales journal. However, this has been correctly recorded in debtors ledger. So personal account, no any problem. Now here, by how much has the sales been undercasted? The actual sale value is 42,000. They have recorded as 24,000. Then sales undercasted by 18,000. So you can add that sale 18. Now you can balance off and find your adjusted debtor control. So 578 minus 20, that is how much? 558,000. 558,000. Okay. Now adjusted debtor control 558. There is no any change in the debtors list reconciliation. Therefore, debtors list balance is 558. In total of balances of debtor ledger before correcting above errors, 558,000. The revised balance of debtor control account, 558,000. Okay. Then 35. Identify the accounting concept applied to each of the item denoted A, B, C, D. Before correcting, so now what is the purpose of the debtors list reconciliation? From a corrected debtor balance, we will show the mistakes made in the personal accounts and find out what is the debtors list balance before the correction of any errors in the debtors list in the debtors ledger. Got it? Before correcting means okay. Then A, B, C, D. What are the accounting concepts? Amal Traders writing the business name, that is business entity concept. Business entity concept. Writing for the year ended 31st March 2021, that is periodicity concept. Writing rupees thousands, that is money measurement concept. Then deducting cost of sale from sale, matching concept. You're matching your expense with income. 36. State whether each of the following statements are true or false in relation to the accounting of a sole proprietorship. Okay. The profit of the business could be distributed as cash drawings. That is true. The owner can take the profit he earned out of the business through drawings. Drawings is the method in which the owner takes out the profit for his personal use. B. Goods sold to the owner are accounted as sales of the business. Is that true or false? If we sell goods to the owner, are we recording it as a sale of the business? That is true. According to the business entity concept, we consider the owner and the business as two separate entities. So if the owner pays money and get the goods out of the business, you can record it as a sale. If the owner doesn't pay any money and take the goods out of the business, that is a drawing. Okay. Then see, the donation of goods should be recognized as an expense of the business. True. Donations are expenses. An income statement is not required to prepare when transactions are recorded on cash basis. So on cash basis means we are going to record only cash received and cash payment. Still, we need to prepare our income statement to find out how much of profit or loss we have incurred or earned, right? So that is false. You have to prepare the income statement to find whether profit or loss is earned, even if you are preparing based on cash basis. Okay. Then 37. Okay. An income statement is not required to prepare when transactions are recorded on cash basis. Transactions recorded on cash basis means we are recording only the cash received and cash paid. We are not looking into the accrual concept. That is what they are saying. So they are saying if you are preparing your accounts based on cash basis, don't have to prepare income statement, ignore it, right? But then when we do a business, we have to identify how much of profit we have earned or how much of loss we have incurred. So for that, we have to prepare the income statement even if we are preparing on cash basis. Okay, so therefore that is false. Okay, sorry. Then 37. P&D traders, a sole proprietorship, sells goods on sale or return basis. Unsold goods are required to be returned within a period of 30 days from the date the goods were sent to the agent. On 15th of March 2021, the goods costing 500,000 was sent to an agent. Okay. The selling price of these goods was 700. Now we had sent goods to an agent. That price of the good, the cost of the good is 500,000. The selling price of the goods was 700,000. The agent was able to sell only 60% of these goods by 31st of March 2021. Okay. So then, how much can we recognize as our sale revenue? Sales revenue. That will be 60% of the selling price of the goods was 700. How much is that? 420. Sales revenue 420,000. Value of inventory to show in the financial statement as at 31st March 2021. So the closing inventory amount. Okay. Closing inventory, that is, now you have to see in the cost. Okay. Closing stock cost. Now, if we sold 60%, how much is remaining? If we sold 60% of the goods, 40% will be remaining. So 40% into the cost of the goods are 500. Closing stock cost is 200. Now here, cost is 200. NRV is 210. We record the lower value. The lower value is the cost. Then you have to record the cost value only in this. So FP. Okay. All right. So that is 200,000. 38 and 39. Okay. Then here we have to find the goodwill. Okay. Manjula, no, we have to find the cash brought by Anjula and the profit of the partnership for the year. All right. So now here, Manjula and Sanjula carried out a partnership sharing profit and loss equally. Anjula was admitted as the partner on 1st of April 2020, and she brought cash for both capital and the share of goodwill. On this date, the goodwill of the business was estimated as 1 million. The goodwill of the business is adjusted to the partner's capital account. The profit or loss sharing ratio among Manjula, Sanjula, and Anjula was agreed as 5:3:2, respectively. Okay. Now, additional information they have given, they are telling us to find how much cash did Anjula bring. So then, through the capital account, Okay, Anjula. So there's this Manjula and Sanjula also. Manjula, Sanjula, Anjula. Okay. So then the closing equity balances are the BCD. Closing equity balances are 5,000, 3,200 and 1,800. 5,000. Now goodwill we have to credit based on old ratio, debit based on new ratio. Okay. Now the goodwill of the business is 1,000, 1 million, right? Now if you are dividing it based on new ratio between Manjula, Sanjula and Anjula, 5 is to 3 is to 2, that will be 500 is to 300 is to 200. The old ratio who were there? Only Manjula and Sanjula, and they were sharing profit and loss equally. So 500 is to 500. Then will Anjula have any old profit ratio? No. Then you can balance off and find how much is the cash brought by Anjula. 2,000, 2,000, and the cash brought by Anjula is 2,000. So here technically if you prepare the account only for Anjula, enough, right? So through that you can find out that Anjula had brought 2,000 cash. 2,000. Here you can write it in thousands. Okay. Profit of the partnership. How can you find the profit of the partnership? Profit equals interest on capital plus salary to partner plus profit share. Okay. Interest on capital. In this question, is there any interest on capital? They are not giving any interest on capital. Share partner salary. What is the total partner salary? All three partners salary 800 plus 800 plus 600, that is 2,200. Profit share of all three partners 1,000 plus 600 plus 400, 2,000. So then interest on capital 0, salary to partners 2,200, profit share 2,000. Your profit of the partnership is 4,200. Profit 4,200. Okay. So Hamna, you mean how did I find the cash brought by Angela? Okay. So now you can draw the capital account. Okay. Do you know that new ratio debit old ratio credit thing? Okay. Now is this clear? How I got the new ratio debit 500 is to 300, 200 and the old ratio 500, 500. Is that clear? The total goodwill mentioned in the question is 1,000. So 1 million. So that the new profit sharing ratio is 5 is to 3 is to 2. Then based on that, if you divide it, the new ratio 500, 300 and 200. Is that part okay? Yeah. Okay. Will Anjula have a old profit? What? Based on old ratio, will Anjula have any goodwill share? Was he there earlier? No, he's a new partner, right? Only Manjula and Sanjula was there earlier. So Anjula's old profit goodwill ratio will be 0, right? The old ratio, the portion for goodwill for Anjula 0. Okay. Now we know the closing balance of Anjula. Closing balance of Anjula's capital account is 1,800. So BCD 1,800. Okay. Then when you reverse and find the goodwill 200 plus BCD 1,800, that is 2,000. You take it to the debit side 2,000. Is that okay? Okay, okay. Then next one, the 40th one. No, 39. 39. Total profit appropriated to Manjula. What is the total profit appropriated to Manjula? Now profit will include interest on capital, partner salary and profit share. So then totally for Manjula, the profit appropriated is the share of profit 1,000 and partner salary 800 that is 1,800. Double entry for that will be profit or loss appropriation account debit 1,800, partner's current account under Manjula, right? Name Manjula, credit 1,800. We are removing the appropriated profit from the profit or loss appropriation statement and we are crediting it to the partner's current account. Next one, salary appropriated to Sanjula. Sanjula's salary is 800. So that will also be profit or loss appropriation, profit or loss appropriation account, debit 800, partner's current account, credit, Sanjula, credit 800. That's the double entry for this. For profit, you have to add all the three earnings, interest on capital, profit share, and the partner salary. Here they are just asking for the salary appropriated to Sanjula. Then 40th one. Classify each of the following cash flows of an apparel manufacturing company as per the LKS 7. Okay. Cash received from a right issue of shares. Right to issue of shares is a financing activity. Financing. Dividend received for the investment in shares. Investing shares and you're getting dividends back. That is investing activity. Settlement of the amount payable to trade creditor. Paying trade creditor is a operating activity. Making a down payment of the lease. Down payment. That initial payment is a no. Initial payment. You're paying out from your own money. You're not settling anyone. That's the investing activity. Okay. See here, a lease. So you will make a down when you're taking a lease asset. You will make a down payment with whatever the money you have. You will make a down payment, right? Initial payment. That is the investing activity. The remaining amount only you're taking as a loan. Okay. Here, Samna. Okay. Done. Okay. So now the remaining amount we are buying on loan. For that we will have to pay annual installment. Now installment amount will include the loan amount and the interest amount. Okay. Out of that installment, that liability amount we are paying is a financing activity. The interest amount we are paying is a operating activity. Okay. So make a note of it. Then next 41. Anuradha PLC produces and sells electronic goods. There was a court case in progress as at 31st March 2021 relating to defective goods sold to a customer. Okay, so there was a court case in progress as at 31st March 2021. As at the reporting date, there was a court case going on. As per the legal advice, the company made a provision of 50,000. We have already made a provision and kept on 31st March 2021. Okay. Now, on 25th of April 2021, after the reporting period, the court ordered the company to pay 75,000 as compensation. The court is confirming the amount, 75,000. the directors of the company authorized on 15th of um, 15th of May. So, did the court confirm this before the authorization date? Yeah, the court confirmed it on 25th of April. The directors authorized the financial statement on 15th of May. Therefore, it has happened before the authorization date and it has a evidence on the reporting date. Therefore, it is a adjusting event or non-adjusting event. Is it a adjusting or non-adjusting event? It is a adjusting event that telling to state whether this court order would lead to a adjusting or non-adjusting event. It's a adjusting event. The liability as at 31st March 2025 recognized in relation to the court order. So in liability, are we going to record 50,000 or 75,000 now? We have to record the confirmed liability amount of 75,000. Okay. Yeah. So how as in you ask, how is it a adjusting event? Okay. 42. So I have explained this. There are only 4 types of adjusting events. Okay. There are 4 types of adjusting events. I'll just recap it one more time. If the debtor goes bankrupt, if the court case, if we are getting a final verdict from the court, then if we decide the NRV of the inventory after reporting date, and if we find the cost of our PPE after reporting date, these 4 are adjusting events. But for that to be adjusting also, 2 conditions should be fulfilled. One thing is, it should provide us evidence as at the closing date, on the reporting date. That means, for example, if a debtor went bankrupt, he should be there as at our closing date for us to consider it as a bad debt, to record it, adjust it as a bad debt during the year. Compensation. Okay. The court case should be going on as at the reporting date for us to confirm it's a um, adjusting event. Okay, likewise, it should provide evidence for the reporting date. And also that event should happen before the authorization date. Okay. Mariam, fourth one as in the fourth question. Adjusting. The fourth one is if the cost of the PPE that we have purchased before the reporting period is confirmed after the reporting period. If a particular cost that is to be added to the PP that we have already purchased during the year is confirmed after the reporting period, we have to adjust it. Okay. All right. Then 42. In this question, it is adjusting. Here, see, the court case was going on during the year, right? As at 31st March 2021, the court case was in progress. Okay. Then the final value was confirmed on 25th of April after the reporting date. The authorization date was 5th of May. Okay. So it was before the authorization date and it provides the evidence for the reporting date. Therefore, it is adjusting. Okay. All right. Then 42. Amount of reserve capitalization and public issue of share. So we'll draw the retained earnings account and stated capital account. Retained earnings and stated capital. Okay. Retained earnings opening balance 2500, BBF 2500, closing balance 4000, BCD 4000. Then stated capital opening balance 5000, closing balance 7500. Okay. Profit of the company for the year was 3,500,000. Profit for the year is recorded where? Under retained earnings credit side. It will increase your retained earnings. Profit after tax 3,500. Company paid interim dividend of 500. Dividend paid will come here. Dividend paid 500. Okay. Now, when we balance off, we can find out how much is the reserve capitalized, right? Capitalization of reserve means what? You're deducting retained earnings and giving that as free shares to your ordinary shareholder. So then, when you balance this off, 6,000, 6,000 minus 4,500. Capitalization of reserve is how much? 1,500. Now, where will you record this 1,500? In the credit side of stated capital. You can say retained earnings, 1,500. Then when you balance this off, you can find the share issue. How much of shares you issued on cash? 7,500 minus 6,500. Share issue will be 1,000. So then the amount of reserves capitalized will be 1,500. The amount of public issue of shares 1,000. Here you can write in 1,000. Okay. Then next 42 done. 43. Complete the following sentence in line with the conceptual framework for financial reporting introduced in 2018. The relevance and blank are the two fundamental qualitative characteristics of financial information. What is the other fundamental qualitative characteristic? Relevance, and it should be faithful representation. Faithful representation. Liability is defined as a blank to transfer an economic resource as a result of past event. Liability is defined as a present obligation. Present obligation to transfer an economic resource as a result of past event. The measurement bases are broadly categorized as historical cost and current value. Okay, we can either measure at historical cost or current value. Current value, you have revaluation method, realizable method, all of that. And blank is defined as the right that has the potential to produce economic benefit. This is the definition of economic resource. Now here it is an, and it gives you a hint that the letter starts with a vowel. So economic resource. Now here if you just write obligation, you won't get the mark. Here if you just write resource, you won't get the mark. You have to write the full word of faithful representation. Present obligation, economic resource. So Fatima, we mainly divide as historical cost and current cost. Under current cost only we have present value, revaluation amount, realizable amount, all of that. Okay. So use the broad term current value. Okay. All right. Then 44. Yes, Hamna, you can. I did 7 questions. So firstly do the 5 questions. No, I'm talking about BS. I'm not asking. So firstly do the 5 questions, selected 5 questions. After that, if you have extra time, you can do the all remaining questions also, no problem. Okay. Then 44. Suranga PLC sells machine in the local market. The installation of this machine is also carried out by this company as it requires a specialized knowledge. Then you all tell me, can anyone else install that machine? Can anyone else install that machine? No, only we can install it. All right. Then the selling price and okay. Then how will we earn revenue? How can we recognize the revenue? We will recognize revenue if the control of the asset is passed, right? If the control of the asset is passed. Okay. Now the selling price and installation fee of the machine is 3,000 and 400 respectively. Selling price is selling price 3,000. Installation 400. The company entered into a contract to sell and install 5 machines. Okay. Out of that 5 machines, they have delivered 3 machines and completed the installation of 2 machines. Now, for how many machines are you going to recognize revenue? For 3 machines or 2 machines? Now, here, I told right now in this example, in this question, the installation can be done only by Suranga. Okay. The installation can be done only by Suranga because it requires a specialized knowledge. Okay. Then, now for us to recognize revenue, we have to pass the control of the asset to the customer. So to pass the control of the asset means the customer should be able to enjoy the benefits and face the losses that they are going to what go through because of this machine. The risk and reward should be passed. Okay. Now, without installing the machine, can the customer use it? Without installing the machine, can the customer use it? No. So without installing the machine, is the control passed to the customer? Is the control of the asset passed to the customer? Uh-huh. Can he, okay. For the control to be passed, he should be able to use it. Without installing, without fixing the machine, can he use it? Can he use the machine without fixing it? He can't, right? So then we can recognize revenue only for the assets in which the control is passed. Now, for how many machines is the control passed? Control is passed for only 2 machines. Then you can recognize revenue only for 2 machines. The cost of the machine with the selling price and installation is 3,400. Revenue recognized will be 3,400 into 2. How much is that? How much of revenue can you recognize? 6,800 rupees, 6,800,000. Okay. Now, how do you find the unearned revenue? Unearned revenue, the liability, equals received amount minus earned amount. Okay. See here, the company received an advance of 11 million for this contract. For this contract, we have already got an advance of 11 million. Minus, from this, how much have we earned? How much revenue have we earned or recognized? That is 6,800, 6,800,000. Then how much is the liability amount, unearned revenue amount? How much is the unearned revenue for which we have not passed the control yet? That is 4,200,000. So unearned revenue 4,200,000. Okay. Then next 45. Inventory turnover ratio and inventory residence period. So that third machine, until you install it, you have to wait without recognizing the revenue. After you install it, you can recognize it as a revenue. Okay, Hamna? Once you install it, you can recognize it as a revenue. Until that, it will be unearned. All right. Inventory turnover ratio. Inventory turnover equals cost of sale divided by average inventory. Cost of sale is 420. How much is the average inventory? Opening inventory plus closing inventory divided by 2. 80 plus 60 divided by 2, 70. 420 divided by 70. How much will be the inventory turnover ratio? That will be 6 times. Okay, 6 times. Now, how do you find inventory residence period? Inventory residence period equals, you can, there are two formulas. Here you can take, here they are saying assume the number of working days per annum 360. 360 divided by inventory turnover. Inventory turnover. So 360 divided by, how much is the inventory turnover? We found as 6. 360 divided by 6, that will be 60 days. So you can write here 60. Okay. Or the other equation is average inventory divided by cost of sale into 360. 70 over 420 into 360, that also 60 days. Okay, 46 one out. Then 46. The business produces 10,000 units during the month of July 2021. The variable cost per unit is 600. Identify the following. Total manufacturing cost. How will you get total manufacturing cost? Prime cost plus production overhead. Prime cost plus production overhead will give total production cost. Prime cost is 4,500. Production cost is 3,000. The production overhead, total manufacturing overhead is 3,000. Then what will be your total production cost? Total manufacturing cost will be 7,500. Total manufacturing cost 7,500. In thousands only we have to write. Okay. Then what is the total cost? Total production cost plus total non-production cost will give you total cost. Total non-production cost is 2,000. Then what will be your total cost? Total cost will be 9,500. 9,500,000. Now, how do we find fixed cost? Now, total cost. Total cost is 9,500,000. Total cost, if you can divide into two as prime cost. Sorry. Total cost you can divide into two as fixed cost and variable cost. Okay, fixed cost and variable cost. So now variable cost per unit is 600. Now this is the total cost to produce 10,000 units, right? So what is the total variable cost? Total variable cost is 10,000 units multiplied by 600 per unit. 10,000 into 600 per unit, that is 6 million. So 6 million, I'll write in thousand, 6,000. Then how much will be your fixed cost? Your fixed cost will be 3,500. Fixed cost 3,500. Okay. Then 47. Complete the following statement as to the classification of cost. Okay. The costs are classified as blank and blank for inventory valuation. For inventory valuation, perfect. Direct and indirect. How do we exactly identify 10,000 as variable? 10,000 is not the, see here, The variable cost per unit is 600, right? Okay. And then we are producing 10,000 units. So all these details are given at 10,000 units. So then if for 1 unit variable cost is 600, to produce 10,000 units, what will be the variable cost, the total variable cost? 10,000 multiplied by 600, that is 6 million, right? And out of the total cost, 6 million will be variable cost, the remaining 3.5 million are fixed cost. Is that clear, Fatima? Okay. Now, for inventory valuation, you can divide the cost as direct cost and indirect cost, or you can also divide it as there's an alternative answer, product cost and period cost. Product cost is the production cost. Period cost is distribution, administration, other, and finance expense together. Okay, that's period cost. B part. The costs are classified as blank and blank based on behavior. Then based on behavior, the answer is, yeah, both are okay. You can either do this, you can either write these two or these two. You can't mix and write it, either these two or these two. Okay. Costs are classified as what and what based on behavior. Based on behavior, we divide cost as variable and fixed cost. Variable cost and fixed cost. Correct. Then next one. To find the EOQ and annual total ordering cost is EOQ is order. Okay. EOQ equals square root of 2 into annual demand into cost per order into holding divided by holding cost per unit. Good. So 2 into annual demand 3,200 multiplied by holding ordering cost 1,000 divided by holding cost is 20% on raw material cost. So 20% of 800 is 160. You need to find the square root of. And square root of 2 into 3,200 into 1,000 divided by 160, that is square root of 40,000. Then you can pair up the zeros, 2 zeros make it 1, and the square root of 4 is 2. So then the EOQ is 200 units. Okay. Annual total ordering cost if EOQ is ordered. Okay. First of all, we need to find the number of orders. Number of orders equals annual demand divided by units per order. Okay. The annual demand is 3,200 units. Per order, now they are saying if one order we are ordering the EOQ, that is 200. What will be the number of orders? How much will be the number of orders? How many times should be ordered during the year? Totally for the year, you need 3,200 units. For each order, you're ordering 200 units at a time. Then totally during the year, you will have to place the order for 16 times. 16 times. Then annual total ordering cost. Total ordering cost will be equal to cost per order into number of orders. The cost per order is 1,000 into we are ordering 16 times. The total ordering cost will be 16,000 rupees. 16,000. Okay. All right. Then 49 and 50. A company manufactures a single product and its contribution per unit is rupees 50. Following information relates to two activity levels of this company. Now see here you have to find a quantity, total cost. When we are producing 4,000 units, what will be the total cost? Is it total cost per unit? Total cost 4,000 into 100, that is 400,000. When you are producing 6,000 units, the total cost will be 6,000 into 80, 480,000. So you can see When you're increasing your quantity by 2000 units, your cost, the total cost is increasing by how much? Total cost is increasing by 80,000. Now cost will increase because of variable cost or fixed cost. Your cost will increase because of variable cost or fixed cost. Your cost will increase because of variable cost. Now this change of total cost by 80,000 is because of the change in quantity of 20,000. So you can find the variable cost per unit as change in total cost divided by change in quantity. Total cost changed by 80,000. So the quantity changed by 2,000. Then what will be the variable cost for 1 unit? Variable cost for 1 unit will be 40. Okay. So now here we can find the selling price easily, right? Selling price minus variable cost equals to contribution. Here they have given company manufactures a single product and its contribution per unit is 50. Variable cost per unit is 40. Then what will be the selling price? How much will be the selling price? 40. Selling price will be 90. So you can say here the selling price is 90. Now we have to find the total fixed cost. Now total fixed cost, you can substitute to any of these units and find out. So I'll find it at 4,000 units. At 4,000 units, total fixed cost equals total cost minus total variable cost. At 4,000 units, how much is the total cost? Total cost is 400,000. How much will be the total variable cost? For 1 unit, the variable cost is 40. We are totally producing 4,000 units. So 4,000 into 40 will be 160,000. Then what will be your total fixed cost? 400 minus 160, that is 240,000. Even if you find that 6,000 units, you will still get the same fixed cost. Fixed cost is 240,000. Then the last one, a plantation company is considering to buy a new machine for an organic fertilizer manufacturing product. What? What? The total fixed cost or the variable cost? Which one? 240. So are you clear with this equation? Total fixed cost equal total cost minus total variable cost. Yeah. What is the total cost at 4,000 units? What's the total cost at 4,000 units? That is, here we found, right? 400,000. 400 total cost. Here, number of units 4,000 into cost per unit 100. Total cost 400,000. Okay. Yeah, I'll explain that. You all are clear with this 400,000, right? Both Atika and Amna. Okay. How did I find total variable cost? See here. For 1 unit, the variable cost is how much? 40. We found that. Then for 4,000 units, how much is the variable cost, Atika? 4,000 units multiplied by 40 rupees per unit. That is 160,000. Okay. So total cost minus total variable cost, we will get the fixed cost as 240,000. Both of you okay now? Understood, right? Okay, okay, perfect. Then the last one, A plantation company, they are deciding to buy a new machine, a organic fertilizer for an organic fertilizer manufacturing project. The purchase price of the machine is 5,500,000. The expected useful life and residual value are 8 years and 700,000 respectively. The company paid 60,000 to prepare this project. Further, at the beginning of this project, 150,000 is required as working capital, which is recoverable at the end of the project period. Estimated saving of annual cash flow during this project is 800,000. Okay. You need the total initial cash flow and cash inflow of year 8. Okay, firstly we'll do these two. Purchase price of the machine is estimated as 5,500,000. That will be an initial cash outflow, 5,500,000. Okay, residual value is 700,000. Residual value 700,000, that will be a terminal cash flow. At the end of 8 years, you will get that 700,000. The company paid 60,000 to prepare this project report. Remember this, before starting the investment, if you incur any expense for project report or feasibility study, market survey, research expense, all of these are considered as sunk costs, because after that now you will decide whether to invest or not. Okay, these are pre-operational costs. Those are sunk costs. Okay, which you cannot recover. So that sunk cost is 60,000. You don't record it in your investment appraisal. Okay, not pre-operational. That's in business studies. That's a bit different. Okay, 60,000. Then next. Further, at the beginning of the project, 150,000 is required as working capital. So that will be an initial outflow and you can recover it at the end of the project period. Therefore, it will be a terminal cash flow. In econ, yeah, it's almost same as the definition of sunk cost in economics. So project report. So Fatima, here I am finding the total initial cash outflow. Okay, so however, these all are minus values only. So they are just asking the outflow now. So you can add all those minus values. Okay. And what is meant by that project report? That project report is now before you start the project, to evaluate that project, you will prepare a report, right? These are the expenses we will incur. These are the income we will generate. Because of this, we can, introduce a new product to the this one and that one. You will right tell everything about the project. You can show it to your investors, right? Then based on that project report, based on the success of the project report only, you will decide whether to invest or not. Okay. If the project report is not successful, you will not invest. Okay. If the project report is successful, you will invest. Okay. So, got it. Then what else? What is the estimated saving of annual cash flow due to cash outflow due to this project is 800,000. So that will be annual operating cash flow 800 for year 8. Okay, we are saving the outflow, means that will be a inflow. You're adding it to the year 1 to year 8. Then what will be the total initial cash outflow? 5,650. The cash flow for year 8 will be 800 plus 850, that is 1650. So initial cash flow is 5,650,000. Cash flow, the total cash inflow of year 8, 1,650,000. Okay. Annual operating profit of year 1. How do you find operating profit? Operating profit equals to cash and operating cash, annual cash flow minus depreciation. What is the annual cash flow? Here see, the estimated saving of annual cash outflow due to this project is 800,000. That estimated outflow, your saving outflow means you consider that as an inflow in investment appraisal. 800 minus, what is the depreciation here? Depreciation will be cost is 5,500 minus residual value 700,000 divided by useful life 8 years. Depreciation will be 600. Then if you deduct the depreciation of 600, operating profit will be a 200,000. Operating profit 200,000. Okay. All right. So that's all. Hope everything was clear. If there is any doubt, you all can ask.